Good morning to my 47 subscribers. Thank you so much for supporting me. Two of YouTube's biggest macro voices are sending completely opposite signals. On one side, you've got me, Kevin, who is warning about liquidity stress, solvency risks, emerging Fed meetings, and the potential cracks forming beneath the surface. On the other side, you've got Tom Lee, who's saying the complete opposite, that we're entering a melt-up, that earnings are strong, and the S&P could rally another 10 to 20% this year. So who's right? I've actually watched every macro video from both sides. I actually think Meet Kevin and Tom Lee are pretty good polar macro views. But if you can think of anyone else that you'd like me to have a look at, then please do comment below. So of course, you've probably felt it over the last few weeks. The market has been volatile. Headlines have been chaotic, and depending on who you watch, the story flips 180 degrees. Some people say we're on the brink of a liquidity crunch. Others say we're at the beginning of a major bull phase. And that's the problem. Most retail investors end up bouncing between doomers and optimists, reacting emotionally instead of thinking structurally. The truth is, both narratives sound compelling, but only one of them actually lines up with the underlying data. And look, as you can see, I'm heavily invested in tech. I want clarity, not noise, as all of us should search for. So let's cut through the emotions and break this down properly. We need to start with what each of them is actually saying. Let's start with Meet Kevin, because in my view, he has the loudest emotional impact with 2.1 million subscribers and releasing quite often more than one video a day. His core message is pretty simple, that the market is fragile and most people aren't seeing the cracks yet. His recent video highlights the Fed's emergency meeting with major Wall Street banks. To Kevin, that's not routine, that's a signal that liquidity in the system is under real pressure. Then he draws a sharp distinction between liquidity and solvency. Liquidity being enough cash to keep things moving, and solvency being your debt stack actually making sense relative to the income and assets. And in his view, we're transitioning from a liquidity issue to a solvency problem. He argues that this has happened before. Liquidity dries up, assets fall, loans don't get rolled on, credit event basically. He extends this into tech valuations, which he believes are crowded. High multiple names get punished first and fastest in a squeeze. He also highlights rising delinquencies, stretched consumers, yield curve uninverting, but still not screaming recession risks to him, and bond market volatility as the ultimate canary. His entire framework boils down to one big idea, that we are closer to something breaking than mainstream thinks, and his tone is urgent because the plumbing is his signal, and right now he believes it's flashing yellow. Now let's flip the coin here. Tom Lee is looking at the exact same market and seeing something completely different. Where Kevin sees cracks, Lee seems to see momentum. Where Kevin sees fragility, he sees resilience. His entire framework is built around one core belief, that AI-driven productivity is real, and we're only in the early stages of that payoff. He also thinks tech isn't running on hype, it's running on the genuine surge in productivity, efficiency, margins, and corporate earnings. NVIDIA's forward guidance, for example, alone implies 100 billion plus in AI infrastructure spend over the next 18 months. Profit taking is normal. It's been a leader for a decade. Pullbacks are pauses, not the end of the cycle in his view. Earning breadth is expanding, which historically when that happens, markets trend higher, they don't necessarily collapse. Corporate balance sheets, especially in the large caps, are flush with cash, have manageable debt, improving margins, and open refinancing windows. And sentiment, well, that's still skeptical. Institutions underweight, retail is relatively defensive, money market funds are at record high, and he believes that's fuel for a melt up. So while Kevin prepares for a liquidity accident, Tom Lee is preparing for a market that grinds and eventually rips much higher. So here's the real question. How can two extremely smart people look at the exact same market and one say we're about to break and the others say we're about to melt up? Now this isn't a minor disagreement, this is two completely opposite macro calls, isn't it? Meet Kevin believes the market is driven by liquidity, credit concerns, and financial plumbing. If liquidity tightens, assets fall. If funding dries up, things break. Whereas Tom Lee believes the market is driven by earning productivity and the AI investment cycle. If earnings rise, equity rise. If AI boosts margins, multiples expand. They're of course looking at the same signals in the same markets, but they're focusing on different things here. So Kevin's of course focused more on liquidity flows, the Fed meetings, bond vol, repo, credit spreads, and Tom's of course more focused on earning revision, margins, AI capex. Both Kevin and Tom have incentives, just not the same incentives, and that shapes how they communicate their views on the market. Both need attention, both need engagement, and both are ultimately selling financial products, just in different forms. Kevin sells newsletters, courses, real estate fund, frequent updates, fast reactions, and the sense of emergency is what keeps his audience engaged. His incentive leans towards velocity, more content, quick commentary, and reacting to every major liquidity move. Tom Lee, on the other hand, also monetizes his expertise through institutional research, fund strat membership, media appearances, and an ETF product line linked to his view, but his incentives lean towards conviction and consistency. You know, big institutional clients and ETF investors care less about intraday noise and more about the multi-month or multi-quarter call, right? So incentives are not YouTuber versus analyst, they're simply two different business models requiring two different forms of persuasion. And because their incentives differ, their communication styles differ naturally. Kevin communicates with speed and intensity. He breaks down complex plumbing in a way that is entertaining, fast-paced, whereas Tom Lee communicates with a steadier tone. He's still entertaining, but he's less reactive, more anchored in cycle analysis, and more focused on probability than headlines. So when you put this all together, it becomes pretty obvious why they clash. Each of these YouTubers' styles at the moment is really focused surrounding around one question. Kevin is asking, where does the system break? Where Tom is asking, where do the earnings take us next? The repo collapse is actually a pretty good case study of their different ways of presenting. Kevin spent multiple videos warning it could be the start of a systemic funding issue. You know, I've paraphrased it there because he does talk about it in a number of different videos. Whereas the most recent video with Tom Lee, he basically dismisses it in one sentence, just saying, this is the government shutdown, liquidity comes straight back, just ignore it. In short, it's the same chart, just completely opposite conclusions. So moving on, let's look at liquidity, because that's where Kevin is really focused at the moment. And yes, the repo collapse and messy TGA flows look dramatic, but when you check the actual systemic indicators, nothing's broken. Credit spreads stayed tight, commercial paper markets were normal, interbank funding spread stayed calm. That's why this wasn't a crisis, it was a shutdown noise, not systemic stress. Next, earnings and AI, which is Tom Lee's primary engine. Margins have been stable to rising, big tech keeps beating expectations, AI capex is accelerating, and we're starting to see productivity gains show up in the numbers. This earning engine hasn't rolled over, and that's the main reason the market hasn't yet broken. On the consumer side, we are seeing cracks. High delinquencies, weaker discretionary spend, but the S&P 500 isn't driven by the bottom third of the households. It's driven by large cap corporates, and those balance sheets look pretty strong, right? There's high cash levels, solid coverage ratios, and open refinancing windows. Index performance follows corporate health, and that remains intact. And finally, positioning. Institutions are still underweight, retail investors are defensive, money market balances remain extremely high, and that's not euphoria, it's skepticism, isn't it? And historically, skepticism is a fuel for the upside, and not a sell signal. So when you put these four together, the data leans more towards medium-term strength than a systemic break, unless earnings or AI investment roll over and things crash. So the bottom line is this: Meet Kevin focuses on liquidity and near-term stress, and that lens is valuable. It highlights risks early, and that's why I like watching him. Tom Lee focuses on earnings, productivity, and positioning, and right now, those fundamentals look stronger than the headlines. Short-term volatility doesn't automatically equal a broken market. When you separate the noise from the actual engines, the macro picture becomes a lot clearer. And if you're tired of ping-ponging between doomers and opportunists every week, feel free to subscribe. I try my hardest to break down the actual drivers, no drama, and I'll do it every week. I would also recommend a YouTuber called Defiant Gatekeeper. He releases weekly videos, and it's super well informed. He really does cut the noise. Whilst talking about him, I'd also suggest watching his macro analysis video, and you should really learn how to read macro indicators yourself. It's very similar to what I and other professional investors look at. I'll be doing a video on the macro indicators I like the most in the future. Anyway, that's all from me today, guys. Thank you so much for watching, and I hope you've enjoyed the video.